If you spend any time on social media, you've probably seen the pitch. A young trader flaunts a luxury lifestyle funded entirely by a trading app, promising that anyone with enough hustle can do exactly the same. This narrative completely sidesteps the complex, elite, and deeply chaotic reality of an actual stock exchange floor. But the illusion works. Those curated stories of easy money have fueled a $12 billion retail proprietary trading, or prop trading, industry, heavily marketed toward millennials and Gen Z. Beneath that massive financial footprint, however, lies a harsh mathematical reality that these firms carefully exclude from their viral marketing campaigns. This visualization shows the actual success rate in the retail prop trading industry. Out of every 100 people who pay to attempt a trading challenge, exactly 93 will fail. Only 7 manage to generate any profit. And if you beat those odds, maintaining perfect discipline, your average return sits at just 4%. For context, you can earn a comparable yield by purchasing United States Treasury bonds. You essentially take zero market risk, sit back, and achieve the same result. A 4% return also significantly underperforms historically stable asset classes, like holding real estate or gold. People are voluntarily paying steep upfront fees and enduring immense psychological stress for a system where the absolute best-case scenario mathematically underperforms doing absolutely nothing. The trap begins with a simple transaction. A retail trader pays a steep, non-refundable upfront fee for the chance to pass a quote-unquote trading challenge. Once the fee is paid, the trader receives what appears to be a large capital account. In reality, there is no real money. They are given a paper trading account running on a completely simulated platform. The rules of the simulation are strict. If a trader's losses cross a specific threshold, known as a drawdown limit, the challenge is instantly failed. The account is reset to zero, and the firm keeps the original fee. The prop firm exposes exactly zero of its own capital to the live market. They are simply selling access to a high-stakes financial video game. The profitability of this business model rests entirely on a core statistical concept, gambler's ruin. Gambler's ruin states that in any game of chance where a player has finite capital and a non-positive expected value, bankruptcy over time is a mathematical certainty. The clearest real-world example of a non-positive expected value happens every day inside a casino. This diagram breaks down the math of an American roulette wheel. There are 38 total pockets, and 18 are black. If you only bet on black, you have roughly a 47% chance to win, leaving a 53% chance to lose on any given spin. You might string together a few wins initially. But because the underlying math guarantees a 53% loss rate, a heavy streak of bad luck becomes inevitable. If you play long enough, your capital crashes to zero. Prop trading firms map this exact casino math onto their challenges. The strict drawdown limits they enforce act as your finite capital, ensuring you are forcibly cut off from the simulation the very moment you inevitably hit that statistical run of bad luck. When an account gets wiped, it rarely has anything to do with a trader's lack of discipline. It happens because time naturally worked against a system designed with a non-positive expected value. Knowing that no real trades are actually happening, you have to ask, where does the cash come from to pay the 7% of people who actually pass the simulation? This flowchart reveals exactly how the system is funded. The payouts are completely detached from market profits. The cash is pulled directly from the pool of non-refundable fees collected from the 93% of traders who failed. These companies are not trying to discover brilliant financial minds to manage their portfolios. They operate a sheer volume business that relies on vast numbers of people losing. To maintain that volume, the firm actively needs that tiny fraction of winners to receive their payouts. The successful 7% serve as proof of life. Their profit screenshots and social media posts validate the pipe dream, providing exactly the marketing material needed to attract the next wave of hopeful applicants. The retail prop trading industry relies on a closed-loop trap. The customer is actually the mathematical input funding the payouts, where your inevitable losses keep the business running, and your rare wins are weaponized to sell the illusion to someone else.
It's easy to look at prop trading and think, that's a scam. But the real market is different. The real market is rational. Is it though? Because at some point over the last few years, investing itself stopped feeling like analysis and started feeling like a game of chance.
At some point over the last few years, investing stopped feeling like analysis and started feeling like a game of Wheel of Fortune. It is hard not to smile when someone on Reddit turns a weekly options trade into a 2,000% gain and immediately posts a screenshot like they've just finished a capitalism speedrun. But while the chaos is entertaining to watch from the sidelines, it creates a break from our historical baseline. For most of modern financial history, markets were anchored to tangible corporate metrics, the boring adult things like earnings, cash flows, and economic data. Since the pandemic, that story has changed. The strategy of buying quality companies at fair prices was replaced by a singular assumption: buy the dip because stocks only go up. This shift suggests that the relationship between market prices and actual corporate performance has detached. They are technically in the same room, but they are no longer on speaking terms. This disconnect is not just a retail phenomenon. It has moved into the quiet world of institutional Wall Street, where years of professional experience are suddenly becoming a liability. Take Michael Burry, the investor who famously profited $800 million by betting against the housing market in 2008. He is the personification of trusting raw data over market noise. Recently, Burry shut down his hedge fund. He noted that his estimation of value in securities had completely desynced from the markets, a polite way of saying the system has stopped pricing assets based on their actual worth. If the gravitational pull of value no longer dictates the price of a stock or a piece of real estate, it leaves a vacuum in the logic of the trade. When standard financial rules stop working, decades of training and expertise transform from a competitive advantage into a barrier to understanding the current market. To find out what is actually driving these prices, we have to look at a branch of psychology that spent decades living on the fringes of the investing world: behavioral finance. Pioneered by researchers like Daniel Kahneman in the 1970s, assumes markets are not efficient or rational. Instead, it assumes markets are human. Their work showed that we do not evaluate risk objectively. We fear losses more than gains, we anchor our beliefs to narratives, and we instinctively follow the crowd. Traditional investors use these ideas only to explain anomalies, the occasional emotional hiccup like a bubble or a panic. They assumed the market would always return to a rational center. But after 2020, behavioral finance shifted from a tool used to explain edge cases into the primary operating system that everything else runs on. This psychological takeover was triggered by a perfect storm of macroeconomic forces. Historically low interest rates and a massive influx of new investors met a wave of government stimulus that functioned like a fire hose of liquidity. Simultaneously, social media collapsed the distance between receiving information and reacting to it. Narratives that used to spread over months now disseminate in hours. You can see a Twitter tip and deploy capital before brushing your teeth. This speed forced institutions to adapt. Instead of modeling cash flows, they're scraping Reddit for sentiment analysis, because those variables currently explain price action better than traditional metrics. Because frictionless trading and viral narratives now move faster than actual business results, momentum can effectively suppress valuation for years at a time. Looking at the current state of the market requires us to decide which historical era we are actually living through. The question is whether this strangeness is a temporary mania or a permanent shift in how the world works. One theory suggests this is a familiar bubble. History shows that when psychology takes over and prices drift away from reality, gravity eventually shows up and causes the system to shatter. Under this view, things will eventually make sense again. Boring metrics like intrinsic valuation will inevitably dictate prices once the mania exhausts itself. However, the rise of social media and the disappearance of trading friction may have structurally changed the market's plumbing. In this scenario, we have entered a new regime. The stock market no longer primarily weights cash flows, it prices human attention. The outcome depends on whether the historical cycle of mania still holds, or if the technological tools in our pockets have made a return to the old rules impossible. There is a final irony in this debate. The very act of trying to rationally determine if the market is broken might be a symptom of the same psychology that is driving the prices.